Rule number one of investing, don't lose money. So as investors, our first job isn't about finding the upside. It's about avoiding the permanent loss. Today, we start with safety. Let's find some value. As a quick reminder, the content in this video is for educational purposes only and does not constitute personal investment advice. Before we can talk about growth, or valuation, or margins, we have to consider a much more basic question, which is this. When things go wrong, can the business still continue to survive? As we mentioned, if the goal of a business is to maximize long-term sustainable value creation for customers, then the most important thing is for the business to continue existing in order to do that. Any business, no matter how strong, will face unfavorable conditions during its lifetime. Recessions, technological shifts, regulatory changes, many of these shocks can last years, not just months. So from a value investing perspective, we want to ensure that a business has the financial strength, cash generating ability, and structural flexibility to get through these periods of stress and come out on the other side. And if it can't, if the business does ultimately fail, then we're already in the worst case scenario. At that point, we want to make sure that whatever assets are left in the business are at least worth something by the time we get paid. Why is that? Well, as equity holders, we're almost always last in line to get paid. Under a typical priority of claims, when a business gets liquidated, first the creditors get paid, then the vendors and employees get paid, and if there's anything left over after that, then the shareholders get paid. So financial safety is of the utmost importance. It's what's going to help us avoid a permanent loss. If a permanent loss is even a possibility, if that's on the table, then the investment may not even be worth it. We might as well put our money at the bank and have the peace of mind that when we go back, it'll be there for us. So what we want is a solid framework to ensure that a business can undergo these periods of stress and come out on the other side. What's going to help us in that regard is the company's balance sheet. Let's quickly walk through what the balance sheet is. The balance sheet is a snapshot of the company's finances at a single point in time. This is one of the key differentiators of the balance sheet compared to the income statement and cash flow statement. The income statement and cash flow statement tell us about a company's operations and performance over a period of time, say a quarter or a whole year. But the balance sheet tells us about the company's financial position or financial strength at a single point in time. So it's a snapshot, not a summary of performance over a period. The balance sheet answers three questions. What does the company have? We call this assets. What does the company owe? We call this liabilities. And what's left over for owners after the bills are paid? We call this equity. Now these three items relate to each other through this simple equation. Assets equals liabilities plus equity. And this equation is not theory. This is true by definition. Assets equals liabilities plus equity. In other words, if a company possesses something, an asset, then it must have obtained that asset either from the business owners themselves or from other people, who are typically creditors. Alright, so let's go through each of these terms and define them a bit more precisely, and also provide some examples for each. Let's start with assets. Assets are resources the company controls that have economic value. Assets can take on a variety of different forms. Some assets are very real and tangible, like cash, equipment, buildings, or inventory if the company is selling physical products. Other assets are completely financial in nature, like accounts receivable, which is the money that customers owe to you, or investments in stocks and other liquid assets. Some assets are intangible. In other words, they're not physical in any way, but regardless are very valuable to the company. These include patents and other intellectual property, trademarks or brands, acquired customer lists. But here's the key investing principle. Not all assets are equally reliable in a crisis. Cash is extremely reliable in a crisis, and ultimately cash is what a business needs in the event of a crisis. A factory, though it may be valuable to a company, is not as useful in the event of a crisis because its value can't quickly be accessed. In an emergency, inventory is a lot more useful than a factory, but at the same time, inventory may be worth a lot less if the company needs to dump it quickly. So when we think about assets for safety, what we're really concerned about is liquidity. That is, how easily can the asset be converted into cash? To put this in perspective, suppose that you incur an unexpected bill, perhaps a large medical cost, or a large home repair. The assets that you can rely on to get you through these types of situations are your cash savings, your stock investments, or anything you have in your possession that you can quickly convert into cash. Your home, though it may be valuable to you, though it may be the most valuable asset you have, is not as useful in that type of situation because it will probably take you a long time to sell it off. Well, the same is true in business. If a business comes across a short-term obligation that it has to pay off immediately, then the assets that are most valuable to it are the ones it can quickly convert into cash. Now, since we're on the topic of obligations, let's dive deeper into liabilities. Liabilities are the claims that other people have on the business. These claims can come from customers, vendors, and lenders. They're the obligations that a company has taken on and that it must now satisfy. Now, this doesn't sound appealing. Why would a business incur these additional obligations? Well, oftentimes, liabilities are an operational necessity. Because of the way a business works and what is required to deliver value to a customer, many businesses have to incur liabilities. Here are a couple of examples to drive the point home. Here in New York, we're home to some of the largest and most stunning apple orchards in the world. These businesses operate year-round, but they only receive large amounts of cash once a year, during the apple season. That's because there's only one apple harvest per year, which happens in the fall. But for the rest of the year, the company still needs to run a business, pay its full-time employees, take care of its facilities, run cold storage for apples during the off-season, maintain its land, prepare for the next planting season, and so on. In most cases, the orchard would take on a line of credit that it can tap into during the off-season to keep the business running when cash isn't flowing in. Here's another common example, this time involving larger capital expenditures. Imagine a manufacturing company that produces specialized industrial equipment. To operate at scale, the business needs a factory, expensive machinery, and customized production lines. These assets aren't optional. Without them, the company simply cannot deliver its product. But the issue is timing. The factory and equipment require a large upfront cash outlay today, but the economic benefits arrive gradually over many years in the form of product sales and operating cash flow. In this situation, taking on liabilities is not reckless. It's practical, because without them, the company would need to accumulate decades of cash before it could ever scale. But here's the trade-off. Once the company has taken on that debt, it's committed itself to fixed payments, regardless of whether demand is strong or weak. If the market takes a turn for the worst, the factory doesn't get any cheaper to run just because sales slow down. This is why liabilities can be a double-edged sword. They enable growth and operations, but they also create obligations that reduce a company's flexibility if conditions deteriorate. Here are a couple of examples of some liabilities. Accounts payable. This is what a company owes to suppliers. Accrued expenses. These can take on the form of wages, taxes, or interest expenses. Unearned revenue. This occurs when customers prepay for products or services that the company hasn't yet delivered to them. And then, of course, other debt like lines of credit, long-term debt like loans or bonds to finance large capital assets. Some liabilities are flexible. For example, suppliers might give you more time to pay. Other liabilities like debt are less forgiving. But in general, the principle is this. Liabilities create deadlines that companies have to meet, and those deadlines in turn create forced decisions. A company can have an amazing product and a loyal customer base, but it can still fail if its obligations come due at the wrong time. Alright, with that, let's move on to equity. Equity is the residual claim. In other words, it's whatever is left over for the business owners after everyone else gets paid. Another good way to think about equity is that it's a portion of the company's assets that actually belongs to the owners. If the owners were to sell the business, they would sell it for its enterprise value. But then they would have to pay off creditors and anyone else they had obligations to. So the equity value is generally what the owners will walk away with when the business is sold. Now, the terminology we had previously used, residual claim, describes really well why stock investing is inherently risky. That's because as shareholders, we're the last in line to get paid. If a company gets liquidated tomorrow, first the secured creditors get paid. Then the unsecured creditors get paid. And then everyone else with a contractual obligation on the company will get paid. If anything is left over after that, the shareholders get what remains. This is the priority of claims idea we had talked about before, and the practical investing takeaway is this. Equity is what helps a company absorb shocks. If a company comes under stress, equity determines how well the company can deal with that stress. Debt does not absorb shocks. Debt demands a payment. Equity is what takes the hit, and if there's not enough equity to absorb the shock and help the company rebound, then owners will be left with very little if the company is unable to recover. Okay, so those are some basic definitions and concepts we need to start evaluating a company's safety. Let's get to that now. We're going to split safety up into two components, short-term safety and long-term safety. Why do we do that? It's because businesses can be safe in the one sense and unsafe in the other. For example, a company might have plenty of cash today, but a lot of debt over the next 3 years. Or it might have low overall debt, but not enough liquid resources like cash to get through the next 6 months without raising money. So here's the distinction. Short-term safety is about liquidity and time. Long-term safety is about solvency and endurance. Now let's dig into each of these, starting with liquidity. Liquidity is the company's ability to meet obligations as they come due, without needing to do something desperate. Now what does desperate mean? Here are a couple of examples. Issuing new stock at a low price. This would dilute existing shareholders. Borrowing more from lenders at high rates. Selling assets in a fire sale. Or cutting core investments like R&D or marketing just to survive. Now, on the other hand, solvency asks the following. Can the business support all of its obligations with its earnings power, not just in a good year, and not just under normal conditions, but also during downturns, industry slowdowns, and unexpected shocks? What makes a company solvent or not essentially boils down to how optimally financed the company is. In other words, what sources of funding drive the company's ability to function well, and are those sources optimized given the particular business model that it operates? This requires us to understand the company's capital structure. In other words, the mix of debt and equity financing the company relies on. As we mentioned previously, these two sources of capital, equity and debt, will behave very differently under stress. Alright, so that's it for today's material. We've now got a solid understanding of the balance sheet and what it can communicate to us about a company's safety. In the next video, we'll dive deeper into liquidity and solvency and calculate some specific ratios that will provide us with even more clarity. Alright, we'll see you there.